Here's a question I ask every B2B leader I sit down with. What does it actually cost you to grow? And this isn't your marketing budget. This isn't the commissions or the spiffs you pay when a new customer gets landed. I mean the full, honest, all-in number, what it costs your business to bring on one net new customer and keep them long enough to make money. Almost nobody can answer that. And that's not a people problem. That's a model problem. If you don't know what it costs to grow, you can't price it, you can't resource it, you can't scale it. You're running a revenue system you don't actually truly understand. And you're wondering why you get results that keep surprising you. Today, we fix that. This is part one of a two-part series on mathematical models that we build at Roadmap Agency. Today, we're covering the foundations, the unit economics that sit underneath every revenue decision you make. Cost of growth, cost of retention, and tiering your book movement that tells you whether your existing book of business is working for you or against you. Get these right, and you'll see your business differently. I promise you that. Welcome to Driving Growth, the go-to-market podcast for traditional B2B businesses that are looking to build systems to create predictable revenue. In short, turning their company into a revenue factory. I'm your host, Steve Whittington, and president of Roadmap and a believer in one simple truth. Sustainable growth is not an accident. It's engineered, and my company Roadmap is a builder of go-to-market systems. Let me start with a truth that most traditional B2B companies haven't fully absorbed. Revenue growth isn't random. It's a mathematical output of a system. The companies we work with, manufacturers, distributors, dealers, professional service firms, typically in the $5 to $55 million revenue range, are not missing their growth targets because they have bad products or bad people. They're getting what they get because they're running a system without the mathematical models and targets needed to drive it forward. They don't know what their cost of growth is. They've never calculated their cost of retention. They've never looked at their book of business by account and asked which of these is actually producing, which is declining, which has gone quiet, and it's costing me more to serve than it's returning. So they rely on hope. They set targets based on last year's number plus a percentage. They call it a plan. That's not a plan. That's a hope cast. Today, we build something better. 3 components, the unit economics layer of your revenue factory. Each one is a number you can calculate, track, and act on. Cost of growth, cost of retention, and expansion or contraction ratios. So if you're a listener of this podcast, you have heard me rant about this many, many times. The first ratio, the first thing you need to figure out is your cost of growth. So what is the cost of growth? It's more than what, the customer acquisition cost. It is a ratio. It's a headline number that tells you whether your actual growth is healthy and on side, and you've got a revenue factory that will fund growth, or you're actually going in the hole. So how do you calculate the cost of growth? So you have to take your total acquisition costs, and your total acquisitions include marketing spend, software, sales labor. You divide that by your gross margin of the free cash flow that you generate from your sales, times it by 100, and that gives you a percentage. Essentially, the closer to 100%, the closer to the fact that your free cash flow is break even. So if you have a ratio, let's say we have an idea where we make some sales and we generate $100 in gross margin or free cash flow from that sale, and it costs us $20 to actually get that sale. Okay, so then our cost of growth will be 20%. And so it's 20 cents on every dollar of free cash flow that we present. So this is what this means though. This means it tells you how much you're keeping, and it shows you that your growth isn't cannibalizing, and you have the ability to reinvest and scale this if you have a less than 100%. Now that being said, it depends on the structure of your business. 100% might not be bad if you have very good reoccurring revenue, but It is the first ratio that you need to determine. After you've determined this macro ratio, the one that tells you whether your business is structurally healthy or that you've got some adjustments that you might want to make. So you might have been making some investments in what you thought was going to help you grow, like potentially say like a expensive billboard buy, and it didn't get you any new customers. So structurally that didn't make sense. Your cost of growth was, over 100%. You now start to understand, okay, well, I've got that figured out. Well, what is my customer acquisition cost on a per customer? And we want to be very precise in how we calculate that. Again, you want to put in every expense that can go towards getting new customers. So that does mean salaries of your sales team and commissions of your sales team and marketing spend, trade shows. It could be software costs for a CRM. It could be association memberships. All these have to be tallied up and appropriately weighted to determine what your customer acquisition cost is. So when you have your total costs, and let's just do a simple number that your total costs are 100 and you get 10 new customers in the period you're measuring against, that means your customer acquisition cost is $10. And so now you know how much it costs per customer. And you also now know what your cost of growth is. So you could have, okay, well, I've got a 20% cost of growth and a $10 customer acquisition cost. I'm now armed to start thinking about if I can efficiently scale this business because I've got the first ratio, cost of growth determined. I have a reasonable customer acquisition cost. Now I can look at the resources going into this and start to figure out where I can put on the gas to actually increase the amount of customers that I'm acquiring. Now, depending on how this is going, some people have a customer acquisition cost that is quite high. Like you could be at 140%. So it's costing you $1.40 per dollar free cash flow that's coming in. And that might not look that attractive. You could be like, wow, it's cost me more to get a customer than I'm actually getting in that say 1 year period that you're looking at. So this comes into the next thing that you want to think about is your customer acquisition cost payback period. So if you're a typical B2B in which customers might buy some stuff once you land them, they buy stuff from you every month or every 3 months, they continue to buy from you. How many months does it take to pay back acquiring this customer? So that's an important metric to know because it makes you really sit up and think about how am I resourcing the onboarding and the retention of this customer, which is what we get to in ratios a little bit later. So after you figured out your customer acquisition cost and your ratio, your cost of growth, you now want to think about your payback period. The next ratio after you're armed with that, and it could be 4 months, it could be 8 months, it could be 12 months or 16 months, you get into the final ratio that you want to look at for this whole fundamental section of your revenue factory is your lifetime value to customer acquisition cost ratio. Okay. Now, essentially, you want this to be the higher, the better. But a good rule of thumb is if it's over 3 to 1, you've got generally a healthy situation. And if you have less than that, probably your growth model is unstable, meaning you have pretty high churn, or it's costing you too much to acquire, or you're not getting big enough customers, so your actual average account size and average transaction size are too low. So something is off in the revenue factory if you're underneath that ratio. But when you look at this, when you look at these numbers, okay, you back up to a macro level and we look at our whole acquisition side of this as part of the revenue factory. The first area that we're looking at is all these acquisition numbers. We now have the cost of growth ratio. We have the customer acquisition cost. We have the customer acquisition payback period, and we have the lifetime value to CAC ratio. And when you look at all these together, you'll have a pretty good idea of how sustainable and how healthy your revenue factory is for acquiring customers. And if the numbers are off and need to be looked at, you now know where you can look to fix and adjust and get your ratios healthy. Hey, we'll get back to the show in just a second. Here's a shocking stat. less than 30% of Canadian B2B companies have a documented go-to-market strategy. And if you want to know where you stand, go to roadmapagency.com and become part of the Go-to-Market Readiness Index and get yourself benchmarked across your peers. It's free, it's worth doing, and it gives you a one-on-one gap analysis on which you can define your future. Links in the show notes. All right, we've done the first ratio, the cost of acquisition, the cost of growth. We've got that figured out. Now, in parallel, you can be determining your cost of retention. So you've got your cost of growth, which, it's costing you, say, 20 cents on a free cash flow dollar. How many cents on a free cash flow dollar out of your existing book of business is it costing you to retain said book of business? And what happens is when you're looking at determining your cost of growth, you're like, okay, we've got this BD guy, we've got the CRM, we've done some marketing, we've got trade shows where we see existing clients, but so not all the trade show costs can go towards acquisition because we see our clients at this trade show. So you have a natural discussion and split that occurs. So part goes into acquisition, part goes into retention. So you figure out all the resourcing that goes into retaining your accounts, wages, as I said, software, events, all that stuff. And you could even have volume discounts and stuff like that, which is part of the retention, the cost of retention. And so what you get is, a cost of retention, which is a certain percentage of your free cash flow. And the old adage is that it costs more to get a customer than it does to retain a customer. And that, for the most part, every time we look at it, is true. You have a 30% cost of growth, and you'll have, say, an 8% cost of retention. And what we see in most traditional B2Bs is that the cost of retention is single digit or low double digits. And then, of course, the other ratios fall out of it. So you've got your customer retention cost, which is a number, and you can say, geez, I'm spending $1,500 per year retaining my customers. And then you see what your customer retention cost is, a ratio, lifetime ratio against that account. And then you see your payback period. So those are all numbers that really help make strategic decisions to inform how you're going to resource this section of your business. So certainly, if you notice that your cost of retention and how much you're spending on a per account is quite low, that might be a signal that you can resource it more to help expand your accounts. Now, that leads to the third component of the revenue factory, the mathematical modeling. We've figured out the cost of acquisition, we've figured out the cost of retention, and now we move to looking at our existing book of business and seeing if we have an expansion or a contraction ratio to work with. So you have to take your accounts and you can break them into 3, 4, depending on the nature of your business, but typically 3 to 4. And it really comes down to, here's the categories. You've got your tier 1, which are strategic accounts. They're the highest revenue, the deepest relationships, the largest potential future value. Okay. Tier 2 is the growth ones. They're solid, they're reliable, they might be just steady eddies, or they could have, with the right attention, the opportunity to become tier 1s. And then your tier 3 are your passive or your transactional accounts. They order occasionally, low strategic value, like they're never going to be more than one-off orders, low relationship depth. When you look at your book of business, it is shocking how this plays out every single time. Essentially, 80% of your business is going to come from your tier 1s and your tier 2s, which represent 20% of your customers, pretty much every single time. And I've done this many times with many groups, and it's, it might be 78 to 22, whatever. Like it's right there every single time. So you start there by taking your accounts and tiering them. The other thing that's shocking is how few accounts represent the tier 1s and tier 2s when you actually look at fit and you look at revenue bands. And so now you know that you could have a business that's, say, $15 or $20 million a year, and you really have to focus on 20 accounts because they represent 80% of that business. And those are the ones that really, really matter, that really, really move the needle. And so if you want to grow, you got to Add in like 5 more tier 1 or tier 2 accounts to get growth and hang on to those 20 accounts, retain them. Okay, so now that you've tiered your accounts, you want to look at what's happening to that book of business. Is it expanding? Is it contracting? Is it staying level? So that's where the churn rate becomes really important for understanding your churn of your tier 1 and your tier 2 accounts. So if you've got 20 accounts that represent tier 1 and tier 2, 80% of your revenue, and you've got a 10% churn, you're going to lose 2 of them. So you're going to lose, 10%. Now, if that book of business is expanding by 15% a year and you're losing 10%, you can expect that book of business to grow just naturally by 5%. You take your book of business, you times it by your churn, and you times it by your expansion ratio. And that will give you a really good between the goalposts forecast of where that book is going. So you have a natural expansion rate despite your churn. Okay. So when you start to look at that, you can start to think about, how can I make this better? Well, first off, retain those customers, don't lose them. Second off, maybe if you resource your account management more, your expansion will be higher. So you're going to get a double benefit. You're not going to have any churn and you're going to have higher expansion by putting effort into the expansion with account management. So you get a double bonus. Breaking this out mathematically, seeing the numbers really highlights where you can actually resource things. And adding together, understanding what the customer acquisition cost is, understanding what the customer retention cost is, and then your churn and your expansion of your book of business, you now start to see mathematically where you should resource to actually grow your business overall. Equally though, this book of business could be contracting. And that creates a different formula, which makes you understand what you need to resource in a different way. So again, your book of business could be contracting because you're under-resourcing retention. So you don't have enough account management, and you can stop that, get it from going minus 20 to just 20 or 0. So you're getting a 20% lift just by actually stopping the bleeding by resourcing accordingly. So either way this contraction or expansion works out, you now have all these numbers to help you equip how you're going to address the issue and or exploit the opportunity that you have. So here's what all these 3 components, your cost of growth, your cost of retention, and your expansion or your contraction rate tell you together. These are the true economics of your business, not the P&L version, the revenue system version. What it costs to grow, what it costs to stay, whether your book is building on and concentrated in the right accounts and moving in the right direction or not. Most B2B operators I meet are surprised by at least one of these numbers when we calculate them together for the first time. Usually the cost of growth is higher than expected. The retention cost is invisible. They don't even know it, and it's generally quite low. And their tier 1 and tier 2, they're surprised at how little their book of business is that's carrying 80% of the revenue. But here's the thing. Surprise is useful. Surprise means you now know something you didn't know before that you can act upon and engineer. You can't fix what you haven't uncovered, what isn't visible, that isn't measured. So we want to start measuring these 3 components of the revenue factory to give you mathematical clarity on what you need to do. Okay, this is where I'm going to leave you today. We have gone through the foundations of the revenue factory mathematical models. If you've been listening to this and working along, you've maybe figured out the cost of growth. You've maybe figured out the cost of retention. You've figured out whether your book of business is expanding your tier 1 and tier 2 accounts or contracting. And all of those components have given you a signal that things are good and you can amplify your efforts, or there's something structurally that needs to be adjusted. What we're going to do in part 2 of this series is we're going to go into now what? With these signals, now what do we do? How do we go deeper? What additional mathematical modeling, like efficiencies of various different go-to-market motions, how do we dive into this deeper to actually drive the business? By the end of episode 2, if you've worked through all the mathematical modeling that we put together, you won't have a sales problem that we're just not hitting targets. You're going to have a math problem. And the interesting thing, the difference between, say, a sales problem, which is a bit of hope and effort and luck, math problems can be solved. And that's the difference between hope casting and forecasting. So subscribe now so you don't miss it. Part 2 drops on the next episode of Driving Growth. If you like what you heard, go to roadmapagency.com/resources and please download the Revenue Factory Toolkit, which we just went through the first 3 components of today, and you'll get the mathematical models and the framework for building your go-to-market system. Also, subscribe to the show wherever you get your podcasts, with new episodes dropping on the first and third Wednesday of every month. I'm Steve Whittington. Thanks for listening. Keep building your revenue factory one brick at a time.